This shouldn't be possible. A $50,000 portfolio. $2,100 every single month. And no, this is not passive income in the way you think. Because here's what nobody tells you up front. This strategy can destroy your capital if you don't understand it. And most people don't. I'm going to show you exactly how it works, what it actually costs you, and the one question almost no one asks. Is $2,100 a month really the freedom number you think it is? This is mind shift theory. Let's get into it. Here's the math that breaks everyone's brain. To pay yourself $2,100 a month, you need $25,200 a year. On a $50,000 portfolio, that's a yield of 50%. 50% per year. The S&P 500 pays 1.3%. The most respected dividend ETFs out there pay 3 to 8%. Put your entire $50,000 into any of them, and you're getting maybe $140 a month. A nice dinner. Not freedom. So how does anyone get to 50% yield without getting scammed? That's the question. And here's what makes it uncomfortable. If the whole market yields 1 to 8%, something yielding 50% means you're giving something up. Something big. The question is, what? Hold that thought. The answer is going to change how you look at income investing completely. Think of this portfolio like a building. Foundation, walls, engine. The foundation is your defensive income. Two names: Ares Capital, ARCC, and Main Street Capital, MAIN. These are business development companies. By law, they distribute 90% of taxable income to shareholders. Combined yield, roughly 9 to 10%. ARCC has paid since 2004, through 2008, through COVID, through 2022. Never cut its base dividend once. That's not luck. That's structure. Put $10,000 here. Annual income, around $920. The walls are monthly paying credit funds, PIMCO's closed-end funds, PDI and PTY. Think of these as professionally managed bond portfolios that pay you every single month. Combined yield, around 12 to 13%. PIMCO is the largest bond manager on earth, and PDI has never missed a distribution since 2012. Put $10,000 here. Annual income, around $1,255. This is where most people mess up. They stop here, see $181 a month, and think the strategy is broken. It's not broken. The foundation is just doing its job. Boring. Stable. Recession-resistant income. Now here's where it gets interesting. The engine. This is the part that gets you to the title of this video, and the part that can wreck you if you don't understand what you're actually buying. Let me show you something that might change how you see this completely. There's a category of ETFs that yield 70, 80, sometimes over 90% annually. The cash is real. It hits your account every single month, and it has nothing to do with dividends in the traditional sense. These funds sell options on stocks like Tesla and MicroStrategy, collect the premium, and pass it directly to you as income. When volatility is high, they pay more. When markets are calm, they pay less. The income is genuine. But here's the cost. And this strategy can destroy your capital if you miss this part. When the underlying stock crashes, the fund takes the full hit on NAV. When it rallies hard, the fund can't fully capture it. So your income stays high while your principal quietly erodes, month after month. The Yield Max Tesla fund launched at $20. After Tesla's collapse in 2022, it dropped to $13, while still paying out every month. Investors got their cash. They also lost 35% of their base capital. That's the trade. Cash now, in exchange for capital later. And that trade is the entire engine of this portfolio. To hit $2,100 a month, you need roughly 70% of this portfolio in these high-yield option income funds. The remaining 30% in the BDCs and PIMCO funds as your floor. Run the numbers and you land at just over $2,179 a month. The math works, but you need to decide if the trade works for you. Now, does any of this survive a recession? Here's the part most income YouTubers skip. The BDC and PIMCO layers will drop in price during a downturn, but historically, the income keeps flowing. ARCC never cut its base dividend in 2008 or 2020. Main actually raised its payout through COVID. Price down, income up. That's the design. The option income layer? This one surprises people. In a crash, volatility spikes. And higher volatility means higher option premiums, which means these funds can actually pay more during a market collapse, even as the NAV continues to fall. So yes, the income survives a recession. What doesn't survive intact is your share price. If the market drops 30%, Your $50,000 might be worth $35,000 to $40,000 on paper, while still paying you $2,100 a month. Whether that bothers you is the most important question in this entire video. Because here's what $2,100 a month actually buys. In San Francisco, it doesn't cover rent. In Cleveland, it covers rent and groceries with nothing left. In a small town with a paid-off house, it's genuine breathing room. The freedom number is not a number. It's a function of your life, your geography, and what you've decided actually matters. And here's the shift most people completely miss. The wealthy don't chase yield. They build systems that produce cash. Then use that cash to build the next system. A $50,000 portfolio paying $2,100 a month is not the destination. It's the tool. Reinvest those distributions at 8% compounding, and you're looking at over $1 million in 25 years, without adding a single new dollar of savings. The portfolio is the printing press. Your job is to keep it running. 2 buckets. That's the whole framework. Bucket 1. Wealth building capital. Money meant to grow for 20 plus years. Index funds. Dividend growth ETFs. Do not put this money in option income products. You will watch it quietly disappear. Bucket 2. Cash flow capital. Money you specifically want converted into present-day income. This is where the BDCs, the credit funds, and a carefully sized position in option income ETFs belong. Most serious advisors say no more than 10 to 20% of total net worth in this category. Size it accordingly. Automate everything. Reinvest the wealth bucket. Direct deposit the income bucket into savings, and review quarterly, not daily. Watching NAV erosion every morning is how you make the wrong decision at the worst possible time. Here's what this all comes down to. Most people don't have a yield problem. They have a clarity problem. They don't know what the money is for. And a portfolio without purpose is just numbers on a screen. The $50,000 blueprint is real. The $2,100 a month is real. But the only way it works, truly works, is if you understand the trade you're making every single month you hold it. Cash now, capital later. Choose consciously, because in the end, the goal was never the yield. The goal was the freedom. And freedom isn't a number. It's a decision you make before you ever open a brokerage account. If this shifted how you think, even by 1 degree, hit subscribe, drop blueprint in the comments, and I'll send you the full allocation breakdown as a free PDF. And watch the next video on screen right now. Same framework, $100,000 portfolio. Real recession stress test. This is mind shift theory. Wealth isn't something that happens to other people. It's something you decide to understand. See you in the next one.